Welcome to Edgemoor Investment Advisors' video presentation of our third quarter 2024 market review and outlook. My name is Gay Truscott, and I'm joined today by my colleague Steve LaRosa. Our agenda for today's presentation mirrors the topics discussed in our quarterly newsletter, which can be found on our website, www.edgemorinv.com. Our agenda today will cover the following topics. Market gains continue in Q3, but volatility rises. The Fed goes big. The U.S. economy, resilient but slowing. All eyes on the November election. Portfolio implications and actions, and Edgemoor's outlook. And finally, a review of two securities we are currently buying. Let's get started. The stock market carried its strong momentum for the first half of the year into the third quarter of 2024, driving most equity indices to record highs. But the third quarter gains came with higher volatility than we saw in the first half of the year. You can see from this chart that the volatility index spiked sharply in early August, only to retreat at month's end before ticking up again in September and early October. In fact, the S&P 500 index saw nearly double the number of 1% daily price changes between July and September that it did in the first half of the year. Uncertainty surrounding the election, interest rates, and global conflicts contributed to the market swings, as did a temporary shift away from the long-dominant Magnificent Seven tech giants. Despite this increased volatility, the overall trajectory of the markets remained positive in the third quarter and for the year. The S&P 500 index, the broadest measure of the stock market, posted a total return of 5.9% in Q3 and 22.1% for year-to-date through September. This marks the second year in a row that the S&P 500 has notched double-digit gains in the first 9 months of the year. Bonds also gained ground in the third quarter, with the Bloomberg Barclays Aggregate Bond Index posting a total return of 5.2%. For the year-to-date period, bonds were up 4.4%, reversing a negative total return from the first half of the year. Bolstered by a combination of a resilient U.S. economy, lower inflation and interest rates, and solid corporate earnings and GDP growth, the market rally that started in 2023 has continued to reward investors in 2024. The Fed goes big. The Federal Reserve went big on its first rate cut in more than 4 years, lowering its benchmark federal funds rate by 50 basis points, or 0.5%, in mid-September. The move actually surprised many market watchers who were expecting a more modest 25 basis point cut. But the Fed went big, citing a labor market that has slowed and an inflation rate that is moving sustainably toward its target of 2%. Remember, the Federal Reserve has two policy mandates: stable prices and full employment. With inflation seemingly under control for now, the Fed has shifted its focus to the labor market, which started to show some signs of underlying weakness in the last few months. This led Fed Chairman Jerome Powell to the position that a recalibration of interest rates was necessary, leading to the half-point rate cut. He also stated that the Fed will make future decisions meeting by meeting, but he left the door open for additional rate cuts later this year and into 2025. Stay tuned. Now let's turn to the broader U.S. economy, which is still showing considerable strength. As I mentioned, the labor market is slowing, but inflation has cooled. U.S. GDP growth remains positive, corporate earnings are still solid, and mortgage rates are moderating. So let's look more closely at these primary indicators. First, U.S. unemployment. Although unemployment is down near historical lows, the labor market started showing signs of weakness during the third quarter, though it did surprise to the upside in September. Overall, though, we've seen the unemployment rate rise pretty steadily over the last year, from 3.5% in July of last year to 4.1% in September of this year. The total number of unemployed people has also risen to 6.8 million in September from 6.3 million a year earlier. On a positive note, despite an overall slowdown in employment, the number of actual layoffs remains quite low. On the inflation front, core inflation has continued to decline toward the Fed's 2% annual target. In September, core CPI was 2.4%, continuing a steady decline since last March. The September reading was the smallest increase in inflation since 2021, and significantly less than the peak of 9.1% in June of 2022. Despite this progress, not all sectors of the economy have seen a slowdown in price inflation. Specifically, shelter inflation remains stubbornly high, and prices for food, which moderated slightly, were still higher month over month. But offsetting these increases were energy prices, which have declined significantly in the last 6 months since May of 2024. Turning to the next slide, U.S. GDP grew at a healthy 3% rate in the second quarter, driven in large part by healthy consumer spending. For the third quarter of 2024, the Fed's GDP Now model currently forecasts this trend to continue, with U.S. GDP forecasted to grow 2.5%. Pretty healthy. Corporate earnings, which really are the primary driver of stock market returns, have also remained solid. As shown in this graph, S&P 500 earnings showed strong year-over-year growth in the second quarter at 11.1%, and this is projected to continue to grow in the third and fourth quarters. For the full year 2024, analysts are projecting 10% earnings growth for the S&P 500, followed by 15% growth in 2025. Finally, U.S. mortgage rates have finally started to decline, despite a recent uptick, thanks to the Fed's actions in September. While we still have a long way to go to solve the nation's housing affordability issues, the decline in mortgage rates over the last year is an important first step, and one which could provide a tailwind to the U.S. economy going forward. Now, all eyes on the November election. With November 5th fast approaching, we expect this highly charged and razor-thin presidential race will continue to impact markets in the near term. But history has shown that elections do not drive markets over the long term. Instead, it is the underlying health of the economy, including corporate earnings, GDP growth, and interest rates, that drive long-term market returns. This chart is one of my favorites. It shows that under both Republican and Democratic administrations, going all the way back to the 1920s, the overall trajectory of the stock market has been consistently positive, the only exception being under Herbert Hoover during the Great Depression. It is our job as investment advisors to put the political noise aside and focus on economic and business fundamentals. Our goal is to stay invested in high-quality companies and continue to look for new investment opportunities, remaining focused on fundamentals such as earnings, growth, and valuation. Now I will turn it over to Steve to talk about portfolio implications and actions, our outlook for the U.S. economy and markets, and to review 2 selected securities we are currently buying for client accounts.
Thank you, Gay. We remain cautiously optimistic about U.S. stocks, despite lofty valuations. The forward price-to-earnings ratio for the S&P 500 is currently over 21, higher than the 5-year average of 19. But not all sectors or companies carry such high valuations, and we have been able to find pockets of opportunity in areas like energy, healthcare, and financials at substantially lower valuations. This selective strategy has and should continue to benefit disciplined, value-oriented investors like us, as a long-awaited broadening of the market rally beyond just the tech giants continues to take hold and reward sectors previously left behind. Specifically, we are seeing a shift in investor focus to utilities, telecom, and real estate, all segments of income-oriented securities which we own and should benefit from lower interest rates going forward. We also still find short-term Treasury bills attractive at risk-free rates of 4 to 4.5%, and are looking in some cases to extend those maturities to lock in these rates for longer durations. Overall, we maintain a positive long-term outlook for the U.S. economy and markets. It appears that the Fed has orchestrated the soft landing that it targeted, but which many thought was unachievable given the delicate task of slowing the economy enough to tame inflation, but not too much to send it into recession. Although recession risk is never completely eliminated, we do not see it as a major risk in the near term. We believe our patient, disciplined approach to individual security selection offers our clients strong long-term return potential in a cost-effective and tax-efficient manner. Even though markets can be volatile quarter to quarter and year to year, we emphasize to our clients the importance of sticking with a long-term investment plan focused on their specific goals and objectives. We appreciate your confidence in our investment philosophy. I am now going to present our analysis of 2 stocks we are currently buying. The first is NVIDIA Corporation, and the second is Public Storage. NVIDIA, arguably one of the most talked about stocks in today's market, holds a dominant position in the design and manufacturing of advanced graphics processing unit, or GPU chips, used in a wide array of applications, including artificial intelligence, or AI. NVIDIA is benefiting from an enormous first-mover advantage in the implementation of AI applications across a variety of industries and users, creating a powerful network effect among the company, AI developers, and data center operators. As the market's most advanced AI hardware and software player, NVIDIA is crucial to the global build-out of AI infrastructure, which is still in the early stages. Its upcoming Blackwell Advanced chip will mark the launch of the firm's next-generation product and commence its next leg of growth. The company's CUDA software is widely used and deeply embedded in the AI ecosystem. This combination of best-in-class hardware and software offerings gives the company a wide economic moat with strong competitive advantages, entrenched customers with high switching costs, and intangible assets. Strong demand for NVIDIA's advanced chips has led to triple-digit year-over-year revenue and earnings growth for the past 5 consecutive quarters. Investors have good reason to believe that this growth is a durable, multi-year trend for the company, having already propelled it this year to a market capitalization of $3 trillion, behind only Apple and Microsoft. As one prominent tech CEO aptly stated recently, the long-term risk to enterprises is underinvestment in AI, not overinvestment. NVIDIA will continue to be a beneficiary of this flow of capital spending as companies find new ways to adopt and monetize AI. We have a favorable view of the company's prospects, as it has solidified a critical role in the global ecosystem by continuing to innovate and produce the world's most reliable, powerful, and efficient AI chips. With a forward PE to growth ratio of 1.2, well below its 5-year average of 1.9, we view the shares as modestly undervalued and thus a good opportunity for long-term investors. Now I'd like to discuss one of Edgemoor's income investments, Public Storage. Public Storage is a real estate investment trust that acquires, develops, owns, and operates self-storage facilities for personal and business use. Public Storage is the largest owner of self-storage facilities in the United States, with physical presence in most major markets and across 40 states. As of June 30th, 2024, the company held interests in over 3,000 self-storage facilities, aggregating approximately 219 million net rentable square feet. Public Storage's occupancy rate is consistently above 92%, which is among the highest in the industry. The company's strategy is to own and operate self-storage facilities within a 3 to 5 mile radius of densely populated urban centers and invest aggressively in enhancing its coverage, scale, brand, operating efficiency, and technology platform. The self-storage sector and is considered a more recession-resilient industry as demand is steady and largely driven by naturally occurring life transitions. Today, the traditional self-storage uses like downsizing, moving, and adding space are being supplemented by additional demand drivers such as urbanization, the decluttering trend, increasing business demand, migration, population growth, and lower home affordability. Self-storage remains a highly fragmented industry, with the 5 largest players controlling approximately 36% of the U.S. inventory, and the remaining 64% being owned by regional operators. This paves a long runway of growth for Public Storage, with just 11% market share, as the company continues to make acquisitions and take market share from smaller competitors. We believe Public Storage will continue to gain market share and grow its earnings based on its scale, strategically located facilities, brand recognition, superior data and market intelligence, and access to low-cost funding. Overall, Public Storage exhibits the characteristics Edgemoor seeks in income investments, including solid business fundamentals, growing earnings, and increasing dividend payouts over time. We are also proud to share that Edgemoor Investment Advisors has been ranked number 14 on CNBC's 6th annual Financial Advisor 100 list for 2024, which ranks and recognizes the top investment advisors in the country. This marks Edgemoor's 4th year on the list, and this accomplishment is a true testament to our firm's consistency, longevity, track record, and experience. Those attributes have been key to our success in the past and remains our goal to maintain in the future. The list is based on a proprietary methodology developed by CNBC in partnership with data provider AccuPoint Solutions, taking into consideration data that's culled from more than 40,000 RIAs nationally. That concludes our third quarter 2024 presentation. We hope you found it helpful and informative. Please feel free to reach out to us with any questions or comments. Thank you for tuning in, and we hope to see you back next quarter.